In this video, we're going to walk through a few short problems on stocks issued with other securities, in other words, lump sum issues. We'll take a look at two methods of allocating the proceeds from these security issues. One, the proportional method, and the second is the incremental method. These should look familiar. We use these for allocating the purchase price of fixed assets as well as multiple inventory items. Recall from back in Chapter 10, if we had a lump sum purchase of fixed assets, we allocated the total cost among the various assets on the basis of their relative fair market values. Let's go ahead and take a look real quick at the proportional method. In our first example, a company is issuing shares of both common stock and preferred stock for a lump sum of $13,500. We simply take a look at the fair values of each. The fair values of the common stock is $6,000. The fair value of the preferred stock is $9,000. So common stock accounts for 40% of the total. Preferred shares 60% of the total. So we'll allocate the $13,500 proceeds from issuing these two securities in the same proportions. 40% of the $13,500 or $5,400 will be allocated to common stock, and 60% of the $13,500 or $8,100 will be allocated to preferred stock. If we only knew the fair value of one of the securities, let's assume the common stock, it's currently trading and we're now going to be issuing additional common shares with preferred shares, how would we allocate the proceeds of the $13,500? Well, in this case, we would use the incremental approach. We know the fair value of the common shares, so we will allocate $6,000 of the $13,500 to the common shares, and then the remaining $7,500 will be allocated to the preferred shares. Let's go ahead and look at some more detailed problems. We're told that Waterway Inc. issues 500 shares of $10 par value common stock and 100 shares of $100 par value preferred stock for a lump sum of $105,000. We're asked to prepare the journal entry for the issuance when the market price of common shares is $172 and the market price of preferred shares is $215. And then we'll do it also in the incremental approach when we only know the market price of the common stock. So in the first method, when we use the proportional method, the common shares are worth $86,000. That's the 500 times the 172. The preferred shares are worth $21,500. That's 100 shares times 215 for a total of $107,500. The relative proportions then are 80%. 86,000 divided by the 107,500 is 80%. The 21,500 by the 107,500 is 20%. So we will allocate the proceeds 80% to common stock and 80% to preferred. Again, we got $105,000 in cash. We're going to record the common stock at its par value, 500 shares at $10 a share. And then the remainder of the 80% of the issue proceeds, or $79,000, will go to capital in excess of par. And that's the 105 times 80% minus 5,000. So in total, 84,000 has been allocated to common stock. And of course, the remaining 23,500 will be allocated to preferred stock. We will record preferred stock at its par value of $10,000. And then the remaining $11,000 will get allocated to additional paid-in capital preferred stock. In the incremental method, where we only know the value of our common stock, we'll take the total sales proceeds, which were $105,000, allocate first to common stock, and again, that's going to be our 172 fair value or market price times the 500 shares, and then the remaining $19,000 will be allocated to preferred stock. So our journal entry will have $105,000 debit to cash, common stock, 500 shares at $10 par value or $5,000, and then $81,000 for the additional paid-in capital. There's the $86,000. And then the remaining $19,000 will be allocated to preferred stock. We recorded the 100 shares at their par value of $10,000, and then the remaining will go to additional paid-in capital.